You know, usually when we picture the future of transportation,
Yeah.
we focus almost entirely on the hardware. Like we picture this steering wheel turning by itself in this empty cabin.
Right, yeah. Or, the laser sensors spinning on the roof of a car like some kind of high-tech crown. It really feels like pure magic operating right in front of you on a normal Tuesday.
It does. But the reality, the actual high-stakes, multi-billion-dollar battle for the future of self-driving cars, well, it isn't happening on the asphalt at all,
No, it's really not.
right? It is happening on that glowing rectangle in your pocket.
Yeah.
Because while everyone is so obsessed with the technology of a car driving itself, the real war is over whose app you open to summon it.
Exactly.
So welcome to the deep dive. Today, we are cutting through all that sci-fi hype of robotaxis to understand the brutal, blood on the tracks business reality of the autonomous industry.
And we really have a massive stack of data today to help us figure this out.
Yeah, we're looking at everything from foundational academic predictions from the Christensen Institute to breaking financial news, Wikipedia histories of rising startups.
Plus some great insights from a niche newsletter called the Driverless Digest.
Right, and even some bleeding-edge crypto analysis from Reddit. We are pulling all of this together to answer one big question. Who will actually own the future of how you get from point A to point B?
Is it the massive tech companies building the robots or, the ride-hailing apps that already control the customers?
It is a massive question.
It really is. And to understand the absolute chaos happening in today's breaking news, we actually need to rewind the clock a bit.
Okay, let's do that.
Because the battle lines, they were drawn years ago. Most notably in a 2019 research report from the Christensen Institute, they made a very specific, very bold prediction about how this entire market would unfold.
And they base that on the theory of disruptive innovation, right?
Exactly. They based it entirely on that theory.
Which, that's a phrase that gets thrown around a lot. People tend to use disruptive to just mean something that is new and cool.
Yeah, totally. It's a buzzword now.
But in economic terms, disruptive innovation has a very strict definition.
It does. The theory, which was originally conceived by Harvard Business School professor Clayton Christensen, it's fundamentally about competitive response.
Right.
A disruptive innovation usually starts at the very bottom of a market. It's often this cheaper, highly accessible alternative that the established giants completely ignore.
Like they just don't take it seriously.
Right, they ignore it. Then it relentlessly moves up market, getting better and better until it ultimately kills those established giants.
But the 2019 report looked at self-driving cars and concluded the exact opposite.
Yes, they did.
They looked at the tech and said, wait a minute, autonomous vehicles are not a disruptive innovation at all. They are a sustaining innovation.
Which is the key to everything happening right now. Well, a sustaining innovation doesn't destroy the existing market leaders. It actively entrenches them. It improves their existing products, lowers their costs, and, makes their current business model even more profitable.
Oh, really?
Think about the unit economics of a company like Uber or Lyft. Their absolute biggest operational headache and their biggest expense is compensating human drivers.
That makes sense.
So if a fleet of autonomous vehicles suddenly becomes viable, improving safety and completely wiping out the cost of human labor, that is a massive sustaining gift to the incumbent ride-hailing networks.
Because they don't have to build a network from scratch.
Exactly. Uber already has the brand equity. They already have billions of rides of historical routing data. And most importantly, they already have you opening their app.
So it's kind of like, think of autonomous tech like a radically faster microchip.
Oh, that's a good way to put it.
Right. Like, when a new chip is invented, it doesn't destroy the computer manufacturer. It doesn't put the established laptop brand out of business. It just allows them to sell a better, faster computer and keep the profits.
Precisely. And the report predicted that because of the specific dynamic, the incumbents, the Ubers of the world, would be the ultimate winners.
They even gave advice to the startups, didn't they?
Yeah. They actually advised the deep-pocketed tech players building the robots to avoid head-on competition and just focus on being the operating system for the ride-hail apps.
Wow.
And they told smaller startups to go find tiny niche markets, like running low-speed shuttles in retirement communities, because fighting the ride-hail giants directly would just be suicide.
Okay, but wait. I have to admit some confusion here, or at least I want to push back on this premise a little bit.
Sure, go for it.
We're talking about tech giants with endless billions of dollars. Companies like Alphabet, Google's parent company, which owns Waymo,
Right.
they have an astronomical cash balance. Wouldn't a tech giant with endless billions eventually just crush a middleman app like Uber anyway, just through sheer force of capital? And
Um,
why would a hardware giant ever let the app company win?
if we connect this to the bigger picture, you have to look at the economic moat Uber has built.
Okay, it relies on a very specific type of capital efficiency.
Hmm.
Uber's ultimate superpower isn't necessarily its routing algorithm, it's the fact that its business model historically relies on absolutely not owning the cars.
Oh, right. Because owning the cars is a nightmare.
It's a capital-intensive nightmare. You have to buy the physical assets. You have to clean vomit out of the back seats. You have to secure vast real estate to charge them, fix flat tires, and absorb the massive blow of vehicle depreciation.
And Uber just avoids all of that overhead by pushing it onto gig workers.
Exactly. Waymo, on the other hand, is building the cars, buying the incredibly expensive sensor suites, and running their own maintenance depots.
Okay, let's unpack this. So the theory was that Uber is perfectly positioned to just sit back, let other people burn billions of dollars on research development and physical vehicle depreciation,
Yes.
and then simply plug those finished cars into the Uber app and take a cut.
Precisely. And for a while, it really seemed like Uber was following that exact playbook.
Back in 2020, right? Yeah, in 2020, they made a massive strategic pivot. They actually sold off their own in-house self-driving unit to a company called Aurora.
They just gave up on building it themselves.
They looked at the capital required to build the autonomous AI internally and realized it was just too hard, too risky, and way too expensive to do themselves.
So they adopted what they call a platform strategy. Instead of building the robots, they committed to spending roughly $10 billion on partnerships with autonomous startups.
Right. They decided they didn't want the liability of building the car. They just wanted to command the network that the car drove on.
And that leads us directly to how Uber is currently executing this strategy with a highly strategic partner of Reed.
Yeah, agreed.
This is a fascinating company to look at if you want to understand where the hardware is actually going. According to the Wikipedia histories, Avreed spun out of the self-driving unit of the Russian tech giant Yandex back in 2020.
Right, and today they are owned by a company called Nebius Group, which sold off its Russian assets and retained Avreed.
And they are headquartered in Newburyport, Massachusetts, but they are testing algorithms all over the world, from Austin, Texas, to the Gangnam district of Seoul.
It's a massive operation.
It is. And as of October 2025, they secured a huge investment, up to $375 million from Uber and Nebius, to rapidly scale their fleet to 500 vehicles.
But the reason Uber is pouring capital into Avridi specifically, it really comes down to their architecture.
It's a dual platform
Well,
thing.
yes. Avridi uses a dual platform approach. They aren't just building robotaxis for human passengers, they're simultaneously building sidewalk delivery robots.
Oh, like the ones that look like little high-tech coolers cruising along on 6 wheels.
Exactly those. They cruise along the sidewalk at about 5 miles per hour, navigating pedestrians and curbs. Avridi is currently deploying them for Uber Eats in places like Jersey City, Dallas, and Austin.
Wow.
And at the exact same time, they are taking Hyundai Ioniq 5 electric vehicles, retrofitting them with lidars, radars, and cameras, and deploying them for human transport.
Right. They launched a Robotaxi service with Uber in a 9-square-mile section of downtown Dallas in December 2025.
Yeah.
So by partnering with Avrida, Uber essentially gets all the benefits of self-driving technology across their entire business model. They get sidewalk bots for the Uber Eats division and Ioniq 5s for the passenger division.
All without taking on the R&D risk.
It's brilliant.
It is deeply synergistic. I mean, developing autonomous software from scratch is incredibly complex. But Avridi's genius is in shared technology.
How does that work?
Well, the core perception systems, like how a machine vision camera identifies a pedestrian stepping off a curb and the path planning algorithms, they're fundamentally similar, whether the vehicle is a 50-pound cooler on a sidewalk or a 2-ton car on a boulevard.
Oh, I never thought about that.
Right. So if Avrida can leverage that shared architecture, every time a delivery bot encounters a complex situation on a sidewalk, that data helps train the highway driving car.
It creates a data flywheel.
Exactly. It dramatically accelerates their development timelines and reduces per unit R&D costs compared to a competitor trying to build just one or the other.
So Uber brings the massive built-in demand from millions of customers who just want a burrito or a ride to the airport. And Avride brings this highly efficient, dual-purpose robotic fleet.
It sounds flawless on paper.
It does. But as we see so often in these sources, Deploying hardware into the physical world is never as clean as the algorithms predict.
No, it is not. The physical world is messy, it's chaotic, and regulators are watching very closely.
Right.
As of March 2026, the National Highway Traffic Safety Administration had logged 37 accidents involving everyday vehicles operating in autonomous mode.
37 accidents.
Yeah. And one incident in particular really highlights the messy nature of real-world deployment. In late March of 2026, an everyday car hit and killed a duck in a park in Austin, Texas.
Which, I mean, that sounds almost slightly comical if you just read the headline.
Right, a duck.
But the business implications were immediate and severe. It triggered local outrage, highly negative press coverage, and by May 2026, the NHTSA actually opened a federal probe into everyday over safety concerns.
It really proves that no matter how mathematically perfect the software looks in a computer simulation, you are still deploying two-ton machines into environments with ducks, construction zones, and, unpredictable weather.
Which perfectly explains why Uber's platform strategy relies on having a diverse portfolio of partners.
Exactly.
If a fleet gets benched by federal regulators in a specific market because of an edge case accident, Uber wants other autonomous companies already integrated into the app.
They need the network to keep running seamlessly for the end user, completely agnostic to whose logo is on the side of the car doing the driving.
Right, so Uber's strategy of being the indispensable middleman works brilliantly when they're partnered with a scrappy growing startup like Avreed.
Everyday absolutely needs Uber's customer base to prove their utilization rates and secure their next round of funding.
But here's where it gets really interesting. What happens when the partner doesn't need Uber? What happens when that partner is a $126 billion tech titan who completely refuses to share the throne?
Yeah, that is where the landscape violently shifts from strategic collaboration into an all-out corporate war. We really have to talk about Waymo.
Waymo is the undisputed 800-pound gorilla in this space.
Yeah.
They have 3,800 vehicles on the road. They are backed by the infinite war chest of Alphabet.
Yep.
And according to breaking financial news from July 2026, Waymo formally notified Uber that they are exploring a complete exit from their partnership in Austin and Atlanta by January 2028.
And they had already quietly severed ties in Phoenix back in May of 2026.
So Waymo is taking their cars and going home. Or rather, they are taking their cars and locking them exclusively onto their own independent app.
And the market recognized the threat immediately. I mean, Uber's stock dropped nearly 5% on the news.
Wow.
This isn't just a polite parting of ways to pursue different visions. They are actively trying to regulate each other out of existence.
The sources indicate that the two companies are now heavily lobbying against each other at the state level.
Right. Uber is out there lobbying for regulations that would require hybrid networks, basically pushing for laws that mandate human drivers be kept in the transportation mix.
Knowing full well that Waymo's entire model is built on operating entirely without human drivers.
Exactly. Meanwhile, Waymo is lobbying for extraordinarily high permitting costs.
Because if a city requires tens of millions of dollars just for the permits to operate a robotaxi fleet, it effectively squeezes out all the smaller, less funded competitors like Avreed.
Leaving Waymo as the only dominant player capable of paying the toll.
And the executives aren't hiding it either. Uber's CEO, Dara Khosrowshahi, has been publicly raising doubts about the reliability of Waymo's technology.
Yeah, he's been claiming their cars get confused by bad weather and stop school buses. He explicitly called them far from capable of handling real-world dynamics.
That is some serious trash talk.
It is. But what's fascinating here is if you look at the internal numbers reported by the Driverless Digest, you start to understand why Waymo feels confident enough to just walk away.
They are scaling fast.
Very fast. By April 2025, they were already hitting 250,000 rides with an 8 to 10% month-over-month growth rate. They have incredible momentum.
Which begs the question, why walk away from Uber's massive pre-existing customer base?
It's a big risk.
Millions of people open the Uber app every day without even thinking about it. Why give up that free, frictionless distribution channel when you're trying to scale?
Because this is a clash of fundamental business philosophies regarding commoditization. The Reddit debates we analyzed hit on this perfectly.
What were they saying?
Well, Waymo has spent over a decade and billions of dollars developing a technology that is entirely novel. But if you order an Uber and a Waymo shows up to take you to the airport, your brain categorizes that as an Uber ride.
Oh, true.
Waymo realizes that if they stay on Uber's platform, they risk becoming nothing more than a nameless hardware supplier for Uber's brand.
Right. They don't want to be the server rack in someone else's data center. They want to own the customer relationship end to end.
Exactly. They want you to open the Waymo app.
Which brings us to the core issue. the underlying economics of the app itself.
Yes.
This entire breakup comes down to the brutal math of unit economics, mixed with the very stubborn psychology of how you, the person listening to this right now, interact with your smartphone.
Let's start with the consumer psychology, which those Reddit threads dissected extensively. Consumers, particularly older demographics, have a deep-seated resistance to downloading new apps.
Oh, I feel that app fatigue, personally.
Everyone does. You have to create a new account, verify your email, and most painfully, input your credit card information yet again into an unknown system.
It's a hassle.
Uber has already fought that battle and won. They are securely sitting on your home screen. Waymo is fighting an incredibly steep uphill battle to convince a user to download their specific app just to get a ride when the default option is already in their pocket.
But beyond consumer behavior, there is a massive structural difference in how these two companies handle the physics of demand. We need to look at Uber's blended fleet advantage.
This is critical. Demand for rides is not a steady, predictable line. It is highly volatile. You have massive, sudden spikes during morning rush hour, or when a massive concert lets out at midnight, or, when it suddenly starts pouring rain.
And Uber's entire model relies on dynamic pricing to solve this.
Right. Because human drivers are price elastic, they respond to incentives. When surge pricing hits and fares double, human drivers leave their couches, get in their cars, and enter the supply pool to capture that money. They absorb the volatile surge hours perfectly.
But a fixed robotic fleet fundamentally breaks under that model.
It completely breaks.
Because a robot doesn't care about a surge multiplier. A robot isn't going to log on to make extra cash for the holidays.
Precisely. Waymo's fleet size is static on any given day. They cannot instantly spawn 500 new cars downtown when it starts raining. Furthermore, the Driverless Digest noted that Waymo is actually facing severe vehicle supply chain constraints.
Oh, really?
Yeah, the Jaguar I-Pace, which makes up their current fleet, is out of production. And there are mounting federal tariffs on the Chinese EVs they plan to use for their next generation of robotaxis.
So capital is constrained.
Extremely. If Waymo operates entirely on their own, they are trapped in a mathematical paradox.
How so?
They either have to build way too many incredibly expensive cars just to have them sit idle in a parking lot waiting for a rush hour surge, which is capital destruction.
Right.
Or they have to frustrate their customers with massive wait times when demand suddenly spikes.
Whereas if Waymo stays on the Uber app, Uber solves that utilization problem for them.
Exactly.
Uber can use Waymo's robots to handle the steady, predictable baseload of rides, the random Tuesday afternoon trips to the grocery store, and then use their flexible army of human drivers to handle the crazy Friday night surges.
It keeps the robots constantly utilized and profitable. It makes total sense from Uber's perspective.
But if you look at the KuCoin crypto analyst post in our stack, they distill why this mathematically breaks Waymo's business model.
Yeah, the analyst wrote, Uber needs volume, Waymo needs margin.
Waymo's cars are loaded with custom LiDAR, radar, and edge computing supercomputers. They are incredibly expensive to build, insure, and maintain.
Waymo simply cannot afford to hand Uber a 30% cut of the fare just for the privilege of being listed in their app.
So Waymo is essentially a high-end luxury boutique sale.
Trying to operate inside a massive discount warehouse like Uber.
Right. Sure, the warehouse gets all the foot traffic in the world. Millions of people walk through the doors every day. But the boutique's profit margins are completely destroyed by the massive 30% entry fee the warehouse charges at the register.
Yeah, they just can't survive that way.
The boutique ultimately has to move out, build its own standalone store, and convince customers to walk across the street if it actually wants to survive.
But this raises an important question for this entire deep dive. How does Waymo plan to survive those long-tail scenarios? What happens in sparsely populated suburbs or during those sudden weather spikes without Uber's flexible human drivers acting as a shock absorber?
Waymo is betting its entire existence and billions of dollars in capital on the belief that if they offer a premium, totally driverless customer experience, people will fight through their app fatigue and download a new ecosystem.
They are choosing to acquire users one by one, city by city, just to avoid being absorbed into Uber's machine.
So what does this all mean for you? The next time you tap your phone to hail a ride, you aren't just calling a car. You are actively participating in a massive tug-of-war over who controls the future of transportation infrastructure.
On one side, Uber wants to remain the undisputed king of the interface, commanding a vast, blended army of human drivers and different robots, like of Reed's dual-platform fleet.
On the other side, Waymo wants to pull you entirely into their exclusive ecosystem, controlling everything from the software on your phone to the sensors on the roof of the car.
And that leaves us with one final, rather provocative thought to mull over.
What's that?
Let's say Waymo wins this war of attrition. Let's say they successfully build their own massive, autonomous-only network and condition you to open their app.
Okay.
And let's say a competitor like Zoox does the exact same thing. And maybe Tesla finally enters the chat with their own dedicated app.
Suddenly, consumers end up with 5 different apps for 5 different robotaxi companies clogging up their phones.
Right, and you have to manually check all of them to find the fastest, cheapest ride. If that highly fragmented future comes to pass, won't a third-party aggregator inevitably emerge to combine them all into one convenient mega app?
And if that happens, doesn't the cycle of disruption just reset, putting a middleman right back in charge?
Exactly.
We end up exactly where we started. The real war isn't the physical car navigating the physical street. The true battlefield for the future of autonomy is, and always will be, your home screen. Catch you next time.